Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Red IQ. Check them out. They turn static multifamily rent rolls and P&Ls into actionable intelligence. It's pretty awesome software. It's called rediq.com is where you can learn more about it. Well, today we're talking about multifamily. You know, multifamily's been really the darling industry, hasn't it? The sector has just done incredibly well. And a lot of people, a lot of companies, investors, and REITs and funds have always liked multifamily. Always seems like a fairly safe sector, but it has really soared in recent years. But what should we expect moving forward? There's been a lot of new supply. In some cities, you see a lot of cranes building a lot of multifamily. So how is multifamily really performing? What is the forecast moving forward? And what are investment sales? What are cap rates looking like today? Well, we'll find out this and a lot more. Please welcome my first guest. It's Carl Whitaker, and he's with RealPage. Carl, thanks for being with us, sir.
Thanks, Michael. Appreciate it.
Well, Carl, first of all, let's talk about performance. When you look at the U.S. overall, how is multifamily performing? It seems like the demographics have been in favor and things have been going well. Is it still going well?
Yeah, absolutely. I think, in some internal conversations we've had, we've been exceptionally pleased and almost even a little bit surprised that performance has been this strong this late in the cycle. Our recent 2Q numbers or soon to release 2Q numbers, I should say. We're still seeing 3% rent growth at the national level. Occupancy is well above 95%. If my memory serves me correct, our most recent numbers are going to say somewhere between 95.7, 95.8 at the U.S. level. And again, that's phenomenal. That really underpins or shows you how strong demand that's underpinning performance has been. And I think, as you touched on, there's some demographic tailwinds that are driving that. It's been great. It's been a strong performing sector, and we think that's going to continue for at least the near future.
Well, let's talk about that a little bit. I know you guys do a forecast. You have a recently completed 5-year forecast, and that I think it'd be very interesting to a lot of people. So, what's the future look like?
Yeah, absolutely. Well, let's get our crystal ball out here and predict the future. But something we've noticed in our recent update is we have a lot of late recovery markets, markets that were slow to come out of the recession, are generally still going to be our forecast leaders for the next, let's call it 4 to 8 quarters, maybe even 12 quarters, so 1 to 3 years. Some of our West Coast markets seeing a little bit of an increase in supply year over year, perhaps pulling down some expectations in those markets over the next 1 to 2 years. But a lot of those markets also have very strong bones about them and should continue to perform well over the longer term. There just may be some short-term adjustment, but it's a lot of these smaller markets that are really jumping towards the top of the leaderboard. We do have a pocket of markets in the southeast that, despite having a lot of new construction, have really got some strong demand driving performance there. Nashville, Charlotte, Raleigh-Durham, those are just a handful of those markets in the southeast that supply really hasn't slowed performance down at all. And I think over the next 1 to 3 years, let's call it, we'll continue to see strong performance in those markets.
That's excellent news. So when you look at supply overall, how are we doing? Are we in line where we should be for new supply?
We are. So we're seeing demand match and actually outpace supply a little bit. And that's been the general theme for the majority of this cycle. Our most recent numbers are going to have supply coming in at about 300,000 units. That's really the same mark we've seen for about 3 years now. And as we continue over the next year, it should remain somewhere in that 300 to 330,000 units delivering on an annual basis. But as always, you're going to have individual markets where those numbers do change a little bit. And as I mentioned earlier, it's a lot of these West Coast markets that are seeing a pretty big jump or a pretty big increase in supply. A lot of the Southeast markets haven't really seen a ton of pullback, so that's also driving that overall supply number.
Carl, what do you see for the difference in performance for the A communities versus kind of the B and C, the rest of the market?
Yeah, and that's actually a great question because you would think, and this generally does happen, where your Class A product is going to be competing the most with new supply, always going to be having to contend with those new units coming online. But recently, we've seen rent growth across all asset classes matching pretty closely. You don't necessarily see one asset class widely outperforming any others, and we still see Class A at just a little bit under full occupancy, just a little bit under 95%. But considering we've added, 2.5 million units to the existing base nationally over the past 10 years, I think that's just a phenomenal occupancy rate, and we'll continue to see that as we move forward, where Class A should remain somewhere similar to that. Class C may be hitting a little bit of some headwinds on the affordability side of things. We certainly don't think that there are these widespread affordability issues, but you do run into the issue at times with Class C product. If rent growth is significantly outpacing the increase in wage growth, you do run into some more headwinds there. But Class B all looks good there. Should we hit some sort of economic slowdown in the next 2 to 3 years, then Class B should be in a good position to continue to perform pretty well. So Class A, though, all considered, just real quick summary, performance is good. We think that things look pretty good on that front for the next 1 to 3 years.
All right. And of course, every community and sub-market is different. But when you look at your forecast and you consider new supply levels have kind of been in line, I think you said that rental rate growth has been around 3%. What's your crystal ball tell you for rate growth moving forward? If you look at the market overall, and is it different for A versus B and C?
Yeah, so when we look at our overall rent growth expectations, I think we'll continue to see rent growth in that, let's call it 2.5% to maybe the upper 2% range. It's a little, it would be a little surprising to see rent growth continue to achieve 3%. I wouldn't be surprised to see a little bit of pullback in that. And some of that will be supply driven. Again, I don't think we're overbuilding en masse, but when you are adding new units to the existing base, of course, that's going to be coming online at that Class A price point. So as we move forward, I think Class A, as the overall rent growth number does soften a little bit, I think Class A might get hit a little bit harder than Class B and C. But when I say that, I think that's probably calling for Class A growth somewhere around the low 2% range. So it feels a bit disingenuous to say that it's getting hit. It's just it should be a little bit softer than Class B and Class C.
Right. Well, let's talk about cap rates. How are they performing? What's the trend there when you look at the market overall?
Yeah, so the one overarching theme, or really the one word that encapsulates cap rates over the past 2 to 3 years has been compression, and we have seen cap rates continue to tighten, and that's prevalent across all markets, whether it's your major markets or even some of your secondary and tertiary markets. We have seen those cap rates compress as sales price per unit has gone up, but looking again how late we are in the cycle. Cap rates are still well ahead of that 10-year T-bill. So when looking at other investment alternatives, apartments are still an attractive option. You just might have to be a bit more strategic in how you approach some deals, because we have seen cap rates compress in some urban submarkets to the 2% range. That might make it a little bit harder for some deals to pencil. Some of our cap rate compression has been a little bit tighter on the West Coast markets or some of your East Coast markets. Just you're naturally more expensive markets. You've seen a little bit more compression there, whereas some markets in the heartland, some of these secondary markets in the Southeast, such as Memphis, Greensboro, et cetera, cap rates are still pretty high there, but you also just don't see quite as much investment activity.
Yeah. Well, for all you 2% cap rate buyers, call me. I've got you some better deals. So what do you expect for cap rates moving forward? I know the crystal ball is hard to look at that pretty far out, but what's your expectations?
Yeah, so I think cap rates, they'll continue to compress a little bit, maybe not quite at the rate that we've seen between, let's call it 2010 and current, but you will see cap rates continue to compress just a little bit. But all considered, when you look again at other investment alternatives, multifamily should look to be a pretty attractive investment alternative. But again, perhaps those that maybe were looking at urban centric deals a few quarters ago, maybe start looking at some suburban deals, or perhaps you're looking at some deals further out on the periphery, or some markets that you might not necessarily have considered 3, 4, 5 years ago as investors do chase that yield.
Yeah, well, great advice, Carl, and great information. Thanks for joining us, sir.
Yeah, absolutely. Thanks, Michael.
Look, if you'd like more information, check out the products and services at realpage.com. Now, stay with us. We're going to talk about some technology for multifamily that you absolutely want to know about. Stay with us. I'm Michael Ball. This is America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com. Red IQ. Turning multifamily data into actionable intelligence. Visit rediq.com.